What's going on, everybody? This is Coach Wade, and today I'm going to answer a question that a lot of people have. How does the stock market really work? Now, when many people hear the word stock market, they immediately think about people yelling on the trading floor, flashing numbers on television, or investors trying to get rich overnight. But the stock market is much simpler than most people think. And once you understand how it works, investing becomes a lot less intimidating. Let's start with the basics. The stock market is simply a place where people buy and sell ownership in companies. That's it. When you buy a share of stock, you're buying a very small ownership interest in a business. Think about that for a second. If you own one share of a company, you're actually one of its owners. Now, you may own a very tiny piece, but you're still an owner. Let's use a simple example. Imagine your friends start a business and needs money to grow. Instead of borrowing all the money from a bank, they decide to sell pieces of ownership in the company. People who believe in the business buy those ownership shares. The company receives money to help it grow. The investors become part owners. That's the basic idea behind the stock market. Companies use it to raise money. Investors use it to build wealth over time. Now, why do stock prices move up and down? Great question. Stock prices are often driven largely by supply and demand. If more people want to buy a company stock than sell it, the price generally goes up. If more people want to sell than buy, the price generally goes down. Now, here's something important. A stock price can change every day, even if the company itself hasn't changed very much. Sometimes prices move because of a company's earnings, sometimes because of economic news, sometimes because of interest rates, sometimes because of investor emotions. That's why you'll often hear me say the stock market is driven by emotions in the short term, but by business performance over the long term. Now let's talk about what happens after you become a shareholder. As the company grows, its value may increase. If the stock price goes up, the value of your investment may increase as well. Some companies also pay dividends, which are payments made to shareholders from a portion of the company's profits. Not every company pays dividends, but many well-established companies do. That means there are generally two ways investors may benefit. The value of their shares may increase over time, and some companies may also distribute dividends. Now, here's something many new investors don't realize. The stock market is not the economy. You often hear people say the stock market is up or the economy is down. Those are not always the same thing. The economy includes businesses, consumers, employment, manufacturing, housing, and much more. The stock market reflects the value investors place on publicly traded companies. The two influence each other, but they're not identical. Now let's talk about one of the biggest mistakes people make. Many people think investing means buying one or two stocks and hoping they become the next Apple or Amazon. Could that happen? Sure, but that's not the approach I teach. As you've heard me say in previous lessons, I believe diversification is one of the smartest ways to invest. Instead of putting all your money into one company, many investors choose broadly diversified index funds that own hundreds of companies. That way, you're participating in the growth of many businesses instead of relying on just one. Now, let's address something that scares a lot of people: market declines. Every time the market goes down, you hear headlines predicting disaster. Some people panic, some people sell everything, others decide they'll never invest again. But here's what history has shown us. Market declines are a normal part of investing. They're not pleasant, but they're normal. The stock market has experienced recessions, inflation, wars, financial crises, political uncertainty, and global pandemics. Yet, over long periods of time, it has repeatedly recovered and continued moving forward. That's one of the reasons I teach people to think long term. Don't focus on what happened this week. Focus on where you're trying to be 20 or 30 years from now. Remember, when you're investing for retirement, you're not investing for next Friday. You're investing for the future. That's why in stage 4 of the 7 stages to financial independence, the wealth building zone, I encourage people to invest consistently, not occasionally, not only when the market feels safe, consistently. I generally encourage people to work toward investing 15% of the household income for retirement, not because I know what the market will do next month, but because I believe consistency over decades is one of the greatest wealth building strategies available. Here's the biggest lesson I want you to remember. The stock market is not a casino. It's not about gambling. It's not about trying to get rich overnight. At its core, the stock market is a collection of businesses. When you invest wisely, you become an owner in companies that create products, provide services, employ millions of people, and work every day to grow their businesses. As those businesses grow over time, your investments have the opportunity to grow as well. So instead of asking, how can I get rich quickly? Ask a better question. How can I become a disciplined, long-term investor? Because that's how wealth is usually built. One investment at a time, one paycheck at a time, 1 month at a time, 1 year at a time. I'm Coach Wade, and I hope today's lesson helped make the stock market a little less confusing and a lot less intimidating. Remember, you don't have to understand everything about Wall Street to become a successful investor. You simply need a plan, a long-term perspective, the discipline to stay consistent, and the patience to let time work in your favor. I'll see you in the next lesson.